Nancy, let's start with you, because you've made something a name for yourself when I say that in the area of inflation. Without regard to whether you think it really is persistent or not, if it were to be persistent, what should an investor do?
I think every investor needs to be concerned about inflation, especially retirees, because you're not going to benefit from the wage inflation if you're not in the labor force anymore. So we do live in a real world, and inflation is a risk to every investor portfolio because it reduces purchasing power. I think investors just shouldn't be taking a bet on whether it's transitory or not, and really should have, as part of a diversified portfolio, should own some amount of inflation protection.
Well, just to follow up on that, Nancy, what does inflation protection look like? Is that gold? Is that real estate? What is that?
Well, I definitely have a different view about what inflation protection is. I know a lot of investors look at commodities because that worked in the 70s in the last period of hyperinflation. But I think commodities are like the laptop, I'm talking with you on tonight. It's deflationary. Technology has innovated in that space. So I just don't think commodities are the only way to think about how to capture inflation. I personally like using the difference between short and long dated rates as another measure of inflation expectations outside the consumer price index. I think that's a thing that investors have to keep in mind, is that's just one index. It's like if you were to buy equities, nobody would buy just the Dow Jones index and say, oh, I have all equities. I think investors have to be diversified.
Peter, same question to you. If you
David, I think Nancy makes a really good point about that. First of all, in the commodity inflation time period, we didn't have the same kind of technology boom that we see today. And we didn't have anywhere near these social, I shouldn't say social, but ecologically beneficial ways to actually produce energy. And Nancy's business has really focused on a long-term structural benefit that's out there of taking advantage of the difference between short and long-term rates. And she's made it liquid. And I think that if you want to buy inflation protection, that's a part of your portfolio that you could easily tailor, own, and it would give you protection to do that. You could also own commodities, but you are susceptible to supply and demand changes, political changes, technology changes. So there's more going on in the commodity world than there is in the sort of pure rate opportunity.
So, Peter, let me just pick up on something you referred to, which is what's going on with climate change and some of the things that are being done by the Biden administration and others in response to that. Julian Tell of the Financial Times this week wrote a column in which she called it greenflation, because she said, as we make this transition, it's a massive transition away from greenhouse gases. It's got to drive some prices up. There's got to be inflation. Is she right?
I think she's right. I definitely think she's right. And I think it's a little bit difficult to calculate. So what I mean by that is, we're all going to move towards a green world. That's a good objective, and we should go there. But what we don't know is how long is it going to take us collectively as a global economy to actually get to the point where the green world is efficient, cost effective, and actually produces enough energy for us to operate our world in. And that time period, we don't know. And if we haven't invested enough in carbon fuels to actually have the supply to get us there, we're going to see price spikes. And we're going to see them actually be very rapid and actually quite disconcerting, because you're not going to be able to increase the supply fast enough to be able to deal with the shortfall.
One of the things, Nancy, clearly we have not invested enough in is supply chains all around the world. I mean, it started with semiconductors, but it's gone well beyond that. Take a look at all the ships lined up outside of Los Angeles and even here in New York. What about that as an effect on inflation? Is that going away anytime soon?
Well, it's really a result of the supply shocks around the world. It hopefully will go away soon, but we're also having labor shocks at the same time. So goods and services are not being able to be shipped around the world. Factories are not working at full capacity. And it's a bit of a catch-22 because, something's got to give eventually, and eventually the demand will be met. The question is whether we're going to have higher costs without the earnings per share growth that has been priced into corporate America. If you look at stocks and corporate credit, the markets are really expecting a lot of growth. And when you listen to some of the companies as they report earnings this season, a lot of people are talking about the labor market and the delays and the higher costs that are not necessarily growthy costs. They're more potentially stagflationary costs, or we have higher costs but not the earnings per share growth.
Peter, as I listen to Nancy, a lot of what she describes is the direct result, I suspect, of the pandemic. We had to shut down the economy and then bring it back up. But is it really the cause of what we're seeing, or did the pandemic reveal some underlying structural weaknesses we had, perhaps around the supply chain, having too much devoted to certain countries, like, for example, China? Is it really revealing more structural issues for the economy that have to be addressed?
Well, that's an interesting question. I think you could argue that there was nothing structurally wrong with the supply chain, although it was clearly concentrated in certain areas. I mean, remember the nuclear disaster in Japan, and automobile manufacturers realized that their supply constraints were disrupted dramatically because they were getting a lot of supplies out of Japan in a specific place that was near Fukushima. So natural events do have an effect on supply chain, and COVID had the same effect, although on a global basis. And so, now we're trying to figure out how do we diversify the supply chain so that effect doesn't happen as often. But we're always going to have some aggregation of supply, because ultimately there's a benefit of suppliers being near each other. They use the same kind of labor costs, use the same kind of energy costs. And if those costs are low and attractive, you're going to attract a number of people that produce goods that have an ecosystem around them. So I suspect that you're always going to have these kinds of shocks in the supply chain when you have natural events that are catastrophic. So in that sense, I don't think that COVID exposed a weakness. It exposed kind of the persistent issue you have when you've got a global supply, structure, and effectively there's a concentration in the system somewhere.
And Nancy, finally, we have a supply shock in the sense, as you point out, in the labor market right now. And that may be just we're trying to get people back online. They're still concerned about COVID. Or there could be a more fundamental shift now that's happened because there was the disruption. It's caused people to rethink what they're doing with their lives. As an investor, do I need to have a view on that subject, whether we have a longer-term disruption in the labor market? Or can I invest in a way that I'm protected either way?
Well, I think most investors, when they look at their fixed income portfolio, especially with a lot of people have decided to retire and leave the labor force, that's where inflation, you really don't want to be taking a bet that we're not going to have higher inflation. You want to have diversified fixed income exposure. And many of the indices out there that are core fixed income do not have inflation protection inside of them. And that's because they were older indices that were created before the Treasury started the inflation protected bond market. So I would just say to investors, know what you own, try to be diversified, add lots of things to the portfolio to achieve that diversification. And I think inflation protection is just one of those things that you should have now, especially with the fiscal spending that's happening and the labor market shortages.
And Peter, sort of the same question to you. Are we seeing a longer-term shift in the labor market? A lot of people can't explain what's going on right now.
I think that the labor markets are probably not as flexible as they had been in terms of people moving from state to state in this country. I think that the low-cost labor that was available in developing markets has changed a bit. It's now higher. So that not as much labor supply is moving around the world. So I think those things are definitely in place. And I also think that we've had a long period of time of deflation in wage costs due to one, low wage areas that were manufacturing products. And as Nancy had mentioned earlier, technology that drove costs down. I think technology is probably still going to provide a declining cost curve in the future for labor. And so that I think is still going to be a benefit. But I also think the cost of labor and the cost of high-end labor is going to continue to rise, and there is inflation. And so the sort of deflation benefit that we had in wage cost plus the technology benefit, that's what's going to change. And I think that that will lead to margin pressure on companies. They're going to have to grow their top line and drive their pricing in order to keep their margins.